In today's video, we're going to talk about one of the most widely used rules in retirement planning, the 4% rule. Now, this is used by both advisors as well as a ton of online calculators to help retirees figure out how much they can safely spend from their portfolio. But as we're going to show in this video, there are some major problems that exist with the 4% rule that's very important to understand if you're letting this rule drive your retirement. We're going to talk about what those problems are as well as how to fix those. So let's get into it. Now, for those that don't know, the 4% rule was developed in 1996 by a financial advisor by the name of William Bengen. And essentially what William did is he looked at data going back to the early 1900s to 1996 and looked at a balanced 60-40 portfolio. And he looked at how much could we take from this portfolio from a percentage basis and make sure that we still have enough money left at the end. So how much could we spend from our portfolio? And what he found by looking at the research is the bottom level for what retirees can safely spend from their portfolio is 4%. Now, there are times within history where they could have spent significantly more, a significantly higher withdrawal rate, but the bottom level in terms of what would be a safe withdrawal rate was 4%. This means that if you had a starting portfolio of $1.2 million, you could start spending $48,000 from that portfolio. Now, there would be ups and downs within that portfolio, but this idea here is we're looking at the starting withdrawal rate, and then that's being adjusted for inflation through time, and that starting withdrawal rate is essentially that 4% that you could supposedly spend. But as we're going to show, there are some big problems within this 4% rule that prevent it from matching up retirees' expectations as they move into that stage of their life. First big problem with the 4% rule is there is a ton of timing risk that is built into this given rule. For instance, we're going to take two retirees here, or two investors that are about to retire. Retiree A and retiree B. Now, at the start of 2022, they had a very similar situation. They both had $1 million portfolio. Now, retiree A is going to retire right at the beginning of 2022 before we've seen this market downturn that we're currently in. Now, this retiree had $1 million portfolio, so the 4% rule said they could start out spending $40,000 from their portfolio and increase that for inflation through time, and they would have a safe retirement. Now, retiree B, however, is going to work another 6 months to mid-2022. Now, both of these retirees are invested the exact same way. But because of delaying their retirement by 6 months, retiree B has found themselves with a smaller portfolio due to some market volatility. They currently have a $780,000 portfolio. Well, based on the 4% rule, when retiree B retired, they could only spend $31,200 from their portfolio. Now, this is a huge issue when we think about building your retirement plan off of this 4% rule. The timing of your retirement can make the world of difference based on this rule for how much you can safely spend from your portfolio. So how can this problem ultimately be fixed? Well, we can still use this withdrawal rate idea, but we need to overlay some rules on top of this to make sure that retiree A and retiree B essentially experience a very similar retirement. Well, there's a great paper that I'll link to in the description below by two researchers, Guyton and Klinger. And essentially what they developed is a withdrawal rate guardrail system. Now, essentially how this works is you have an initial starting withdrawal rate. You then have an upper bound guardrail and a lower bound guardrail. Now, how I want you to think about this is when we hit an upper guardrail, that means our withdrawal rate increased. So for instance, in a given scenario, taking the previous example we just used, that first retiree started out spending $40,000 from their retirement assets. As they see their portfolio drop from $1 million to $780,000, it will spike their withdrawal rate. A $40,000 withdrawal on $780,000 is a little bit over a 5% withdrawal rate. And so you'd set an upper guardrail. And anytime we hit this upper guardrail, you would essentially adjust your income down. And so you'd adjust it down to a lower withdrawal rate so we can continue to sustain our portfolio through the rest of retirement. On the flip side, as we see better market returns, our withdrawal rate is going to drop. For instance, if that $1 million grew to $1.5 million over a 2 or 3 year period, well, now we're at a significantly lower withdrawal rate where $40,000 divided by $1.5 million portfolio is about a 2.6% withdrawal rate. And so when we hit those lower bounds, we can then adjust our income up and take more from our portfolio as we see better market returns and raise our income so we're at a withdrawal rate that is acceptable to allow us to maximize our income. Now, understand that this guardrail system is highly customizable. You can set your guardrails at any given distance. You can start with different initial withdrawal rates that can then change the guardrail system, as well as you can build in more aggressive adjustments or more conservative adjustments to that underlying income as well. So let's take a quick look at how this might look in practice. So on the screen, we have a scenario for a couple that has a little bit more than $1 million in retirement assets. Now they want to spend a little bit more than $8,000 per month from their retirement assets. Now, as we build in this dynamic income strategy within their plan, we're going to look at a Monte Carlo, which means 1,000 simulations of their retirement, and we're going to look at everything from the worst case scenario to the best case scenario. Now, as we'll see on the screen, I have it as a dotted line, their goal income moving through time. And in the background, I have the worst and the 10th percentile results here. Now, as you'll see, the worst simulation is the only simulation where we see their dynamic income strategy drop below their goal income here. But as we can see, this appears to just be one poor phase of their retirement because they see that within a couple of years, it then rises back above their goal income. And now as they move through retirement, they're able to spend quite a bit above that goal income ultimately. But we see some of these given adjustments based on poor market returns and better market returns. On the right-hand side of the screen, we can see a summary of their situation. So on average through all of these simulations, this couple sees a rise in their income of about 5.5% on average every 1.3 years. On the flip side, they see very few adjustments. So within these simulations, they see about a 5.7% adjustment down in income every 67 years. And again, this is ultimately what a retirement plan should be able to do for your retirement. Remember that that 4% rule is based off the worst trial that we would have seen historically. And so in the number of cases where the 4% rule works, meaning that you have money left at the end of your portfolio, you oftentimes have such a large surplus that you're leaving a lot to the next generation. Now, if that's your interest, great. But as we'll see, this withdrawal rate guardrail system can allow you to spend significantly more and allow you to enjoy the fruits of your labor. Problem number 2 with the 4% rule is one of, in my opinion, the biggest problems that I see with this 4% rule. And that's that it excludes critical income. And this 4% rule really is only built for a very poor withdrawal strategy. And that withdrawal strategy would be you turn age 62, you retire at 62, and you immediately turn on Social Security. We can see why this 4% rule is built for this. You have the Social Security income essentially filling in your income, and then you can simply take 4% of your retirement portfolio, add it on top of that Social Security income, and simply take that moving through time. But what happens when we're using a better Social Security strategy that delays our benefit, thus earning us a larger benefit? Now, assuming that this is optimal in our situation, the 4% rule really starts to break down. Because if we retire at 62 and we're delaying Social Security until age 70, how much can we take within that first 8-year period? Well, if we start taking 4% from our portfolio, we're going to have a pretty weird looking retirement. For instance, if we start taking 4% from our portfolio during those first 8 years, well, we're going to have some pretty low income in those first 8 years. And then once we turn age 70, we're going to have some significantly higher income because we're now layering on an entirely additional income stream. So how do we fix this? Well, unfortunately, we can't with some simple all-encompassing rule like the 4% rule is meant to be. We essentially need to rebuild withdrawal rates specific to your situation. Now, people are going to be retiring on a different timeline. They're going to have a different Social Security benefit that is going to turn on at different times. And if you're in a married couple, we might have to turn on 2 Social Security benefits and time those given strategies properly. Well, that can change the underlying withdrawal rates in a big way. Well, let's say that we're using this example of someone retiring at 62, turning on Social Security at age 70. Now, under this type of income schedule, we would have seen that this retiree could have started out by spending $82,000 per year from their portfolio. Now, this would have been a 5.8% withdrawal rate, but understanding that that withdrawal rate would have dropped significantly once this retiree turned age 70. And so as we think about different income streams turning on at different times, there will be different phases of your retirement where you might have a significantly higher withdrawal rate that then drops to a lower withdrawal rate based on the timing of that Social Security benefit. If this retiree was 65 years old, they could have even taken a larger withdrawal rate from their portfolio starting out as they delayed until 70. Ultimately, what I think would be most beneficial is to rebuild the 4% rule, but under your exact dynamics. And we would see a much better system being built and one you can safely follow as well. Now, the final problem that I have with the 4% rule is the current application of this 4% rule is incredibly narrow and to a point where it doesn't really benefit benefit real-world retirements. Now, there are a couple different retirement goals that we're going to walk through that I see a lot of retirees have that the 4% rule just fails to meet. So first, we'll find that the 4% rule doesn't exactly mimic real retirement spending. Now, we've talked about this a few different times on our Safeguard Wealth Management YouTube channel, that most people build retirement plans with what I would call a brute force spending method. So they'll take their starting income and they'll simply increase that for inflation through time. But this doesn't exactly mimic what we see from how retirees actually spend their money in retirement. In reality, we find that retirement spending follows more of a smile than we see a static, constant spending line. For instance, retirees typically spend a little bit more on the front end of their retirement, where they have a larger discretionary budget, where they're more active and able to do things. Then as we see them age through retirement, we typically see spending drop. We then see towards the back half of their retirement, they typically spend a little bit more due to healthcare costs. And so if you're building a retirement plan, assuming constant inflation-adjusted spending, you're likely overestimating what you're actually going to need as you move through retirement. And so let's say that we update this 4% rule to follow this retirement spending smile. Well, now we'll actually see an adjustment up, where we see that a lot of retirees can actually spend quite a bit more from their retirement portfolio. And so under the 4% rule, we would have seen that the low for how much you could have safely spent from your retirement was in 1966, and it was technically 4.03%. Well, adjusting this to the spending smile, we would have seen that you could actually spend 4.73% from your retirement portfolio based on that low. Now, for a retiree with $1 million portfolio, this translates to about $7,000 more per year that they can spend right off the front end. Again, that will adjust lower, but again, keep in mind that that mimics real-world spending more adequately than a constant inflation-adjusted spending goal. Another massive issue that I don't think a lot of retirees realize is the 4% rule was based on portfolio depletion, meaning that if we started out a 30-year retirement, and at the end of those 30 years, we had just $1 left in our portfolio, that would be considered a success underneath the 4% rule. Now, this would make a lot of retirees, as well as myself, nervous, because that is an extremely fragile way to build your retirement plan. For instance, this is the wealth path of the 4% rule starting in 1973, starting with $1 million portfolio. And as you can see, there were some large crashes at the beginning of the 70s that led to this portfolio almost being depleted. Now, this is a 30-year retirement, and we see this $1 million portfolio in inflation-adjusted terms goes from $1 million down to around $100,000 by the end of this 30-year retirement. Now, this leaves very little in the way of a safety margin in case there are things like long-term care costs, or what happens if this retiree lives a couple years longer. If we put ourselves in the shoes of this retiree and we see our portfolio depleting over the last, well, I should say really the entirety of our retirement, that would lead to a lot of worrying and a lack of peace of mind. And so if we rebuild the 4% rule to now build in a safety buffer at the end, we'll see the withdrawal rates completely change. For instance, on the screen, I have 3 different withdrawal rate lines. Now, the blue line is the normal 4% rule based on wealth depletion at the end of this person's 30-year retirement. The next 2, however, build in a safety buffer at the end. So, for instance, the orange line is, let's say we wanted to preserve your nominal wealth. So if you started with $1 million portfolio, we know that inflation is going to devalue that $1 million portfolio over time. But let's say that in nominal terms, we wanted to end retirement still with $1 million. The gray line will solve for real wealth. So if we start with $1 million portfolio, we want to end retirement with $1 million inflation-adjusted portfolio. Both of these build in safety buffers at the end of retirement, but obviously with differing amounts. What we'll see with these updated withdrawal rates is that if we wanted to preserve our nominal wealth, the lowest withdrawal rate would have actually happened in 1937. And we could have only taken 3.77% from our portfolio. We would have seen if we wanted to preserve our real wealth moving through time, this gray line here, we would see that the lowest withdrawal rate we were able to take, the safe withdrawal rate, if you will, was only 2.72%. And so we'll see a widely different amount that you can take based on what your goals are at the end of your retirement, whether you want to leave a safety buffer in for the unexpected, or you want to leave an inheritance to the next generation. Another way we can increase our confidence in withdrawal rate planning is looking beyond the US. So the 4% rule was developed by just looking at the US market. And regardless of who you are, you have to admit that the US has been on an incredible run in terms of financial market growth over the last century. If we look at the US relative to the size of the world market, we would have seen that the US was only 15% of the world market. To compare, the UK was 24% of the world market at the beginning of the 20th century. Through the next 120 years, due to growth, we would have seen the US really establish itself as the dominant world power. It now holds a share of about 60% of the world market. And so through that time, we would have seen incredible growth from the US. And so we would expect withdrawal rates to be higher because of that. What if we look, though, internationally, and we look more at a world withdrawal rate rather than just focusing on the US withdrawal rate? On the screen, I have the safe withdrawal rates in 17 developed markets across the world. This was later updated to include more than 22 world markets. And what we'll see is there are only 3 instances in 3 different countries where the safe withdrawal rate would have been higher than 4%, higher than the US. In all other countries, we would actually seen a significantly lower withdrawal rate. Keep in mind as well that this is built under perfect foresight, meaning that they basically looked at the given allocations between stocks and bonds and looked at what would have delivered the highest safe withdrawal rate. And so this is done with a little bit of data mining here. That's done intentionally. Interestingly enough, we would have seen, looking at all of this market data, that 63% of the time, a stock allocation of 70% or more would have been optimal. Now we see this much lower in the US, but it's interesting as a perspective that a larger stock allocation generally wins when we look at international exposures. And if we aggregate all of the world data together, we would have seen that the world safe withdrawal rate would have been slightly higher than 3.5%. So once again, we see an adjustment down when we include more data than just the US. And I think this is very important to note when we look at the statistical significance of the 4% rule. If we're looking at 120 years worth of data and we're looking at a 30-year retirement, there are only 4 distinctly different trials that we're looking at within that 120 years worth of data. Because of this, it's very important to look not only at global data, but also run a lot of these assumptions underneath a Monte Carlo, where we simulate data based on historical parameters. In all of these scenarios, we would have seen the 4% rule update to a lower safe withdrawal rate. And so we see the further that we look at the 4% rule, the more the data gets a little bit fuzzy. In fact, we see some things raise the starting withdrawal rate that we should be able to take, like following the spending smile, while other things adjust the safe withdrawal rate down. Ultimately, I think you should build your safe withdrawal rate under the important dynamics and goals that you have inside of your plan. Now, unfortunately, that won't allow you to use some simple rule of thumb like the 4% rule, but diving into the complexity, you will see, delivers significantly better outcomes to your retirement. And keep in mind that there are things that you can do inside of your retirement plan to improve your safe withdrawal rate, such as tax planning. In this video right here, we talk about 9 common retirement tax spikes that you will see that can creep up on you. Now, avoiding these tax spikes is critical in keeping that safe withdrawal rate the highest that it can be for your retirement. Click on this video right here to learn more, and always remember, you don't need more money, you need a better plan.